Hey YouTube, it's Matthew Decker with Leveraged Wealth Management. I hope that you're doing well today. Today we are talking about tax-free income for life. How do you get it? Why do you need it? Should you even want it? We're going to talk about all that today, and we're going to try to do it in less than 20 minutes. So when we start about talking about tax-free income for life, the first question that we have to ask is, why is tax-free income attractive in this particular environment? And I don't think it takes too much looking around to understand why tax-free income could be attractive in this current environment. Right now, we have over $28 trillion of debt, U.S. national debt, $28 trillion today. And I'm recording this at the end of June 2021. So $28 trillion today. We have over $150 trillion of U.S. unfunded liabilities. And unfunded liabilities makes up things like future Social Security payments, Medicare, Medicaid, interest on our debt. And so those line items right there are things that we've already promised to pay, but we're not currently paying on them now, and that's why they're counted as a future liability, $150 trillion. And when you look at those two numbers and you realize that we really only collect about $3.5 trillion every single year in taxes, and yet we spend way more than that, there's almost no mathematical way for us to pay down our debt and do so without raising taxes. Raising taxes is going to have to be a part of the conversation. And that's why you see things like the Secure Act that was passed earlier last year. We have to spend down inherited IRAs faster. And it's under an accelerated tax schedule essentially at that point because they eliminated the stretch IRA. You have politicians who talk about getting their fair share of your retirement accounts because they do have a fair share in your retirement accounts. You made a handshake deal with the government when you decided to defer dollars into your 401k, IRA, SEP, Simple, 403b, TSP. And it was that you were going to not pay taxes now and you were going to pay taxes when you withdrew those dollars. Well, the thing that not many people think about when they make that deal with the IRS and the government is you don't have control over your future tax rates. And so you're delaying or deferring taxes today to pay them at a later date at an unspecified rate and an unspecified amount. And so a lot of politicians would say we don't have a tax problem. We just got to get our hands on those retirement dollars that are out there. There's about $35 trillion sitting in retirement accounts right now that are currently untaxed. It's the largest sum of untaxed money sitting in the United States that they do have access to at some point down the road. And so it's easy to see why tax-free income is something that is on the hearts and minds of a lot of high earners, because the people that are going to be paying the most tax going forward are those that have done a good job saving, that have a lot of money sitting in retirement accounts that make a good income. And so it pays to be forward thinking, and it pays to be setting yourself up in a way to minimize the taxes that you're going to have to pay once you do get to retirement. One more thing about taxes. We're actually in about the lowest tax rate environment that we've been in decades, a long time. In fact, if you look at just the highest marginal tax rate, just a graph of the highest marginal tax rate going back for as long as we've measured it, you can see that in the 70s is essentially when the IRA and the qualified account, the retirement account came into existence, and you were around a 70% top marginal rate at that point in time. So when the government came out with this new vehicle where you could save money for retirement, delay your taxes for later, it was actually a home run of an idea because tax rates were as high as around 70%. And so you could defer your taxes at a 70% rate and pay it later in the future. Well, if you were deferring in the 70s, chances are you're close to or in retirement now, and you're withdrawing at much lower rates. And so that strategy worked out for you perfectly. It couldn't have worked any better. But we're actually in the exact opposite situation now, where tax rates are about as low as they've ever been, and we've accumulated more debt than ever. And so if you're delaying taxes now and deferring it for later, you're potentially setting yourself up for a huge tax issue when you get to retirement. And I think that's why a lot of people are searching for and looking for sources and streams of tax-free income for when they get ready to retire. So let's talk about those different sources of tax-free income. And I'm just going to go ahead and share my screen here. and start to document some of this out. So when it comes to sources of tax-free income, it pays to know what those different sources are. And so let's just go ahead and list them. So you've got muni bonds, municipal bonds. The income from municipal bonds is tax-free. If you sell the bond, it's not tax-free, but the income from municipal bonds is tax-free. Of course, you have Roth accounts, and those Roth accounts come in just your traditional Roth IRA, and you could also put in there a Roth 401k. So your Roth accounts will be tax-free assets when you go to take that money out. You've already paid tax on it, you put it in, it grows, you take it out tax-free. It's a beautiful account. However, it does come with some limitations. So you can make too much money for a Roth. They limit how much you can put in, and then you don't have access to your gains until 59.5. But those are the limitations of a Roth. Still a wonderful vehicle. You should take advantage of it if you have access to them. You could also do a Roth annuity, which we actually see a lot of now, especially with where bond rates are today. There are some really good no-fee annuity contracts that actually provide better upside potential. They provide better protection on the downside. There's no fees at all, and if you can wrap it with a Roth wrapper, it is actually a really attractive income vehicle as a replacement for some kind of bond portfolio with where interest rates are today. So we got Roth annuity. And then the last one is cash value life insurance. We'll just put CVLI. So those are the forms of tax-free income sources that you can tap into when you get to retirement. And most of our clients tap into 2 or 3 of these different vehicles. Most people that we're working with are not putting their money into municipal bonds simply because of where interest rates are, because of default risk, because of a lot of these different municipalities are underwater and carry a lot of debt. You got a lot of states that aren't funding pensions properly, and so municipal bonds are a little bit of a scary proposition at this point in time. However, they do provide tax-free income if you hold them and just collect the income payments. So those are, the major sources of tax-free income. But once you identify what's available, the next question is, okay, I've got Roth accounts, I've got a Roth annuity, I've got municipal bonds, cash value life insurance. Well, how much of my income do I actually want coming from these different tax-free sources? So how much? And it's a question that everyone should ask. And we say how much in terms of a percentage of your overall income do you want coming from tax-free sources? And we would say that most people arrive somewhere in the ballpark of 20 to 40% of their income being tax-free. And if you structure it right, you can actually get a whole lot higher than that, but it takes a lot of planning on the front end to make sure that you're in that all of your money being tax-free. You'd essentially have to make sure that all your qualified accounts got spent down low enough to where the money you took out of your qualified accounts at 72 when your RMDs start is less than your standard exemption amount, and you don't have any other income, and all your other income sources come from either cash, Social Security, life insurance, or Roth accounts. If you can do that, you can actually get to a point where you pay 0 taxes and all of your money is tax-free. But again, it takes some advanced planning to get there, and it takes moving around some dollars, well before you get to retirement. But the general question, how much of your money do you want sheltered from tax when you retire? And then the other question would be, okay, so if we know that, let's say on the higher end, we want 40% of our money sheltered from tax, well, of that 40%, how much of that tax-free income do we want guaranteed for life? And how much of that tax-free income do we want at risk in the market? It's a great question that everyone should ask because one of the biggest sources of tax-free dollars is going to be these Roth accounts. And those Roth accounts traditionally are going to come with market risk. And if you retire with a lot of market risk, most of your money in Roth accounts in maybe ETFs or stocks and bonds, well, then you have to deal with the issue of sequence of returns, which is you don't know what the market's going to do when you go to retire. The market doesn't care when you go to retire. The market doesn't care what your plans are. And so as an example, if you went to retire in 1999, you had 3 years in a row of terrible market returns, and you run a high likelihood of running out of money at that point. If you retired, 3 years ago, you actually did really well because the market's been on a tear. And so, market timing is something that you have to deal with if the majority of your dollars are going to be actually in the market subject to market risk. And what that essentially means, if we boil it down, is you have to take less risk. If you're going to have more of your money at risk, those accounts need to be less risky so that you don't lose as much money when the market's down. But how much money do you want tax-free? And then the second question is, of that tax-free money, how much of it do you want fixed? How much of it do you want at risk or in the market? You can answer those two questions, and you can actually do yourself a really big favor of knowing exactly which different tax-free sources of income you need to pursue, because those two questions basically tell you what you need to look at. And so then if we talk about, what's the best way to really go about, future planning for tax-free income, knowing that, some people have a shorter time horizon than others, and some people are starting early. Like, what's the best way, or if you could detail this out perfectly, how would you do it? Well, what I would tell you is most people in their 20s to, let's say, 35 years old, if you're in that category and you're forward thinking and trying to build up tax-free dollars for your retirement, you really need to be focusing on building your Roth accounts, okay? Building your Roth accounts. And the reason is because you're in the years of your life where you can afford to take a lot of risk. So you should. You should take as much risk as you're comfortable with. When you're earning a decent amount of money, maybe, if you just got into the workforce, maybe you're not there yet, but you can take a lot of risk. You have a high capacity for taking a risk in the market. You should do so, and you should focus on building up your Roth accounts. Once you get to 35 plus, what we find is a lot of people who do well for themselves in this category, they can't any longer fund a Roth account because they make too much money. And so then to actually get money into Roth, you'd have to do a backdoor conversion or maybe convert some of your IRA assets to Roth. And so what we find is once people get around the 35 years old or older, that's when most people choose to actually start building up their cash value life insurance. And the reason that they choose to do that is because you don't have the same income limits that you're going to have on your Roth accounts. You don't have the same contribution limits that you have on your Roth accounts. And it's a way to get less risky with your money because these are fixed contracts. And if you don't want to get less risky, I guess you could use a variable life insurance policy and it would still have all the market risk that you might want. But the point is, 35 plus, people really start looking towards cash value life insurance because it doesn't have any of the income limitations, contribution limitations, and your money's not locked up until 59 and a half like it would be in the Roth. And it's a great way to start de-risking your portfolio as you ease into those years where you're getting closer to retirement. So 35 plus, that's when people start looking at building up their cash value life insurance policies. Once we get to 50 plus, this is where a lot of our clients actually start considering annuities, and we prefer to put them in a Roth wrapper. So a Roth annuity. And the reason that we start looking at annuities once 50 plus, annuities are going to lock up your money until 59 and a half, whether it's a Roth or not. Okay, so your money's going to be locked up until 59 and a half. And so we don't want to start putting money into annuities when you're in your 30s, right? Because you're just reducing your liquidity. You're just putting money somewhere where you can't really have access to it without penalty. So 50 plus is where we start looking at that. And the two reasons would be, number one, it's a great way to further de-risk your portfolio. And if you answer that question, hey, of my 40% tax-free income, I want half of that to be guaranteed. Well, an annuity is the best way to do that. And you can do it in a Roth annuity and get the best of both worlds, tax-free and guaranteed for life. And if you look at something like an annuity with no fees, it's probably going to beat a bond portfolio. It's not going to be as costly. In fact, it's going to be free from a fee standpoint. And again, tax-free and guaranteed for life. So it's a great opportunity to start looking at once you get 50 plus. And then the other thing that we look at is the first several years of your retirement. that's when we start looking at doing some big Roth conversions. So if you do have a big 401k or a big IRA from a former employer, the first several years of retirement, that's when we're going to look at doing some really thoughtful Roth conversions. Because what you don't want to do is you don't want to do a big Roth conversion in your highest earning years. You want to do that Roth conversion when your income is lower than normal. So what we would say is build up a cash account for the first couple years of retirement, because cash is tax-free. You don't pay income tax on your cash if you use it to live. And so if you can have a year or two of living expenses covered by cash once you hit retirement, that's 1 or 2 years of Roth conversions where you can essentially convert your qualified accounts to Roth assets, and you can be starting at the 0% tax bracket and working your way up through the brackets instead of starting at a 32% marginal rate or something crazy like that and making it worse for yourself. So that would be the best way to do Roth conversions. So just as a recap, you're concerned about tax-free income and you're just starting out, build up your Roth. You're 35 plus, you need to start looking at cash value life insurance. You're 50 plus, that's where we start looking at layering in some Roth annuities for further de-risking of your portfolio and adding in guaranteed income. And first couple years of retirement, those are the years, or if you do it right and you set aside some cash for those years of retirement, you can do your Roth conversions and essentially start from 0% marginal rate and work your way up through the brackets instead of starting at the top end of the brackets and only piling on yourself in the form of more taxes than you would need to pay had you done planning in the first place. And I know that a lot of people watching this video are going to be like, well, Matt, that's great, but I'm already, in my mid 40s and I haven't done either of these two things. Well, it's never too late. Obviously, starting earlier is better than starting later. But with a well thought out plan, even if you're starting late, we can get you to a point where you have the right percentage of tax-free income based on what you want, somewhere between 20 and 40% of your income. And you have the right percentage of guaranteed income that's tax-free based on what you want. Sometimes it's half of your tax-free income. Sometimes it's all of it. It really depends on you and your risk profile and exactly what you're trying to do with your money. But to close, when we talk about tax-free dollars, we talk about the best way to situate those tax-free dollars for retirement. We have to recognize that there's only several types. We've got municipal bonds. We'll add cash in here too. You've got cash. You've got all your Roth accounts. And then you got cash value life insurance. The reason we talk a lot about cash value life insurance is because of these vehicles. It's the most flexible. It has the least gotchas in terms of liquidity, in terms of how much you can put in terms of how much money you can make. There's really no limits in terms of how much you can put into cash value life insurance policies in order to benefit from tax-free income on the back end. But in order of importance, where you should start funding your Roth accounts if you can. If you're already funding Roth accounts or you make too much money for Roth accounts, then you start looking at cash value life insurance. As you approach retirement, you start looking at those Roth annuities and making sure that you've got a year or two of cash built up so that you can do Roth conversions. That's the best strategy that we've come up with for generating tax-free income for life in a way that either exposes you to market risk or doesn't, based on what you're looking for. So hopefully this has been helpful. If you'd like a more detailed plan that's custom built for you in terms of how we can strategize getting you as much tax-free income, as risky or as least risky as you want, then you need to book a discovery call with us. We'll ask you some basic questions about what you're trying to do, what your timeline looks like, how much planning you've done already, and we can actually develop a plan to thoughtfully and methodically convert your dollars to a place where you have exactly the right amount of tax-free income that you want, that you're taking as much risk as you want, and you know when and how you can retire and how that money is going to be taxed once you do retire. So book that discovery call with us if that's something that you're interested in. I'll link that at the top of the screen. I'll also put it in the description below. And as always, like this video, subscribe to my channel, comment below, and let me know what other topics you want us to cover in the future. I look forward to talking with you soon, and take care.